Okay, it's on. So questions before we get going? Anybody? Okay, Chapter 25. This is the last one. Chapter 25 is cost centers. Cost centers are in some ways similar to the horizontal and vertical analysis we did last week. But cost centers are, some people refer to it as departmental accounting. We're going to break down our P&L into different departments within a company. So for example, General Motors, right? We've all heard of them. They have a Cadillac division. They used to have an Oldsmobile division. I don't know if they still do. They have a GM division, right? They have a truck division. So each of those divisions would be responsible for presenting their own financial information so that you can look and see, are we making money making Corvettes, or are we not making money making Corvettes, right? Because if you bury it all in the great big total of all of it, you don't know if I'm doing okay over here or if I'm covering up for it by making a great big profit over there. Good? That's the general concept. Let's see. Okay, this is the whole concept of managerial accounting. For those of you who have had Accounting 1B, this stuff kind of pops up in there, right? It's really designed to be information that's used by management to make intelligent decisions about how to run the business. Sometimes, rarely, you see income statements broken out by department that get published out to the world at large, but for the most part, they're for internal use. Okay? Business segments, certain activities, or you can even do it by product, right? By product. Let's see, we have, if you're Apple, you have an income statement for your iPad product, and you have one for your iPhone 5, and you have one for the iPhone 5C. So you separate them up into different products. Okay? Sound good? The key is, like I was saying a moment ago, it's profitability. You want to know if that activity, if that product, if that business segment or department is profitable, as opposed to lumping all your departments together and going, oh, overall the company's fine. What you can find out by doing this is, oh, hey, if we quit making product X, the company would be more profitable. We make money on four products, but we lose money on this one over here. Drop the fifth one. That's the kind of business decision we're looking at making here. Okay? People nodded yes. That's a good sign for this group. Decision making we talked about. Okay, profit centers, cost centers. Anybody want to take a stab at it? What's a cost center?
Where you're putting it.
What?
Where you're putting it.
It's part of how we categorize it, but a cost center, think about it, and I hate to put it this way, every business has an accounting department, right? Does the accounting department generate revenue?
No.
Therefore, do they ever generate a profit? No. So they're referred to typically as a cost center. Okay? Marketing is a cost center. Okay? It's a business segment that incurs costs but doesn't produce any revenue. It's a simple answer. Okay? On the other hand, we know that. We talked about this. Here's a good one. Cost centers typically provide services to the other departments within a company. So, for example, if you come and apply for a job working for me in my accounting department, we have a conversation about who are your customers. And I'm very clear about you don't interact with the customers of the company. Your customers are the sales guys, the warehouse guys, all the people that we provide services for and information to, the management team, inside our own company. So if you're an accountant, typically your customers are people inside of your own company. Cool? IT guys are also, providing services to people inside the company. Purchasing department, typical. Profit center, on the other hand. Now that we've seen cost center, anybody want to take a stab at this?
Departments that earn money.
That actually sell stuff and generate revenue. She's got it. Okay? produces revenue. It's the whole key. Good? Questions? Answers? She nods her head no. We're down to just one. Okay. Profit centers sell things to customers. Their customers are people outside of the business. What we all typically think of as a customer, right? Okay. Sometimes, this is where this can be a little confusing. Sometimes you will sell things to other departments in your own company. For example, we've been using General Motors, right? General Motors has an engine division, the guys that put the motors together, and they have a transmission division. Well, the transmission division, on paper, sells that transmission to the guys who build the car. It becomes a cost in the car, but they recoup their revenue by charging the cost off to the other department. Okay? So they're in essence kind of selling it to another part of the company. Or if you have, who's a big, oh heck. I'm trying to think of an example, not coming to me. Say we were in some sort of a high-tech industry and we build whatever it is here, some sort of microchip here, and they assemble the computers somewhere else. They assemble them in Mexico, so we sell them to the Mexico division. And the guys over in... So here in California, we make the microchips. In Colorado, they make the hard drives. In Texas, they make the motherboards. We sell them all to the guys in Mexico, the other division that puts them all together. Okay? Same sort of concept. All right? Everybody good with this? Yes, mostly. So the whole point is, we're now going to break down our income statement, and we're going to analyze it based on each of these cost or profit centers. Good? Yes?
So in like a manufacturing company, it wouldn't be the people who are producing the products to sell, it would just be the sales department? I mean, not thinking that they're selling it.
No, it can be different. So in our GM example, you know, the first factory one builds trucks. That's a profit center because they're going to actually sell the trucks to the dealerships. Factory 2 builds, you know, Cadillacs, so there's another profit center over here. The company I work for, we have 16 different warehouses where we actually distribute things to people, and each one gets its own income statement, its own P&L. So I know what your revenue was, what your cost of goods sold was, and if you're being efficient with your overhead that you spend to generate those sales. And the manager at each of those facilities is responsible for his costs. And that's really what it's used for is, you know, are you being efficient? I can evaluate you based on how you're running your segment of the business. The warehouse manager is probably not responsible for the top line revenue, right? That's going to be the sales guys. And he's not responsible for the cost of goods sold section in the middle. That's going to be the purchasing guys. But all the other expenses that go along with driving that, absolutely. Okay, yes?
Certain question, like financial industries, banks.
Yes.
Those kinds of things. They can use each individual retail outlet.
Branch, yes.
Yeah. For this, or can they use, would it be easier for them?
They may not roll it out into that much detail.
Okay.
So pick any bank. They may have the West Coast division, the Mid-Atlantic division, you know, foreign division, the real estate lending division, business loan division. So it could be a group of retail outlets as opposed to each one. Okay? In my scenario, it's each one. Good? Okay. And they're typically broken down at some level of management. So if I have, let's make up a hypothetical. Let's use Starbucks. But it's a hypothetical because I don't know enough about Starbucks. So let's say that there's a manager responsible for the 650 Starbucks in the South Bay area, right? There's probably about that many. So you would do a P&L for those 650 to evaluate that manager's performance. He would want one drilled down a little deeper to manage the people below him and see how they're performing. Okay? So you roll them up and you roll them up and you roll them up at different responsibility levels so you can evaluate performance and manage the business and make a decision about what is creating enough profit and what is not. Okay? What's this? Oh, that's what we're talking about here. You know, it's a responsibility level. So if we have a South Bay manager for Starbucks, they're going to get an income statement for their 650 stores, or how many ever it is, right? It's Starbucks. It might be well over 1,000 stores. I don't know. Okay? So if you're, let's say you're selling something big. Caterpillar, right? They sell equipment. They sell it around the world. So if there's a Latin American division, there's going to be a P&L for the Latin American manager to evaluate how that division is performing. Or the European division, or North America, or whatever they happen to, however they break them down. And again, there's nothing set in stone. This is one of those things where you create an income statement and these departments and divisions based on your specific company's need. Okay? We'll come up with an example here in a second. Yes, we're going to skip that. Okay, departments. Let's just do one. Let's pick Macy's, right? Everybody's been to the mall, they've been to Macy's. Good? Anybody not seen a Macy's? You go into a store like Macy's, how many departments are there? Right? They have clothing, they have shoes, they have kitchen appliances somewhere, they have bedding, they have jewelry, they have, there's lots of stuff, right? So that particular store is going to track each of those departments because each one probably has its own manager, right? And then there's a store manager. So the department manager is responsible for their own department. The store managers are responsible for all of the departments under them. And you want to see if each of the departments is profitable or efficient with the expenses that they're incurring to generate revenue. So to do this, I need a marker. Typically what happens is we've got a chart of accounts, right? Let's say sales is account 500. Good? So to generate a department, and remember, everything's computerized nowadays, they'll put a department out in front of it. So let's say the clothing department is department 1. So there'll be an 01 5000, and shoes are 02. Oh, sorry, not 5,000, 500. I like 4 digits. I'm going 4 digits. Okay? So there's shoes. There's clothing, shoes, jewelry, something else, small appliances, whatever it is, right? So by putting some sort of a department code in front of it, you can achieve these things. Good? Now, if this is truly a Macy's, to think this through, there's probably a store number in front of it. So you've got store, department, revenue. So as you can see, these things for a large company could start to get really big. All of a sudden, if Macy's rolls this out into West Coast, store number, department, general ledger account, right? So you can report at each of these different levels. And you just end up with a chart of account with all of these departments and locations and things like that in front of it. Sir?
What happens when you start getting businesses that own each other, like Lowe's owns Orchards? So would you keep going with those?
Sears bought Orchard. Did they sell it?
Yeah, they sold it.
Oh, okay.
What would you do? I mean, when it actually gets off and they come together, like Orchards has their books and Lowe's has their books.
Right.
You actually put these two together and have
Yes.
one.
And you will at some
And
point.
start just keep adding numbers on.
You will roll this up and come up with a consolidated set of books. So you could have, again, let's do this. Department. So all of a sudden this is an Orchard Supply, okay? Sales, paint, sales, lawn and garden, right? Store 12, West Coast. You probably would go one more in front of that. You would go Lowe's, L-O-W-E-S, Lowe's. They probably own several things, right? Orchard Supply, whatever else they own, you would have a designator in this column out here. So you, all of a sudden, you've got something that's 10 or 12 characters deep, right? So as you're entering account numbers in the computer system. So you just put it out in front. Or some such system. Uh-oh. Pick up the mouse, do things to it. Okay. Questions on that? Okay. So departmental accounts are included in the general ledger, something like what I was just showing you, where they break it down and there's a differentiator and you can identify what's going on. The more departments, the more depth and detail, the longer your general ledger account number is. So you're recording all of your sales by department, purchases by department, expenses by department. So if you know that you're recording the wages for the shoe department, you record it in, what was shoes, 01 dash whatever the general ledger expense is for wages. Okay? If you get a separate utility bill for the shoe department, you would put it in that. But think about it. If you get a utility bill, there's probably only 1 meter on the whole store, right? So then we come into allocating expenses that we don't have a specific. If you don't have an invoice that's specific for a department that you're trying to record, we're going to start allocating things. And that's the next part of this. Inventory is tracked by department as well, before we move on too much further. All right. So we talked about this, recording the sales in each department. You get more than one sales account, you get more than one wages account. For those of you who've taken 151A, where we did the sales journal, since we were just doing this 2 weeks ago in that class, it behaves the same, it looks the same, but you can start to add columns for the sales by department. So instead of just having one sales column, you'd have a column for each department: clothing, shoes, small appliances, jewelry, whatever you need to. You can modify this to work for your specific situation. Good? Everybody see that? Somebody nod your head, yes. Yes, I've taken that class. Good. Okay. Yes, yes, yes. This is the old manual method. Of course, everyone uses a computer now. So here's an example. This is sticking to the Macy's example. I'm calling it the Macy's example with clothing and shoes. So typical income statement: revenue, sales less returns and allowance, net sales. Cost of goods sold, inventory, purchases, freight in, less returns and allowances, less ending inventory gets you cost of goods sold and gross profit. It's a typical income statement to here. Just since we're recording all of the sales each in their own general ledger account by department, you just record all your sales, all your returns and allowances, and calculate net sales for each of the two departments. Okay? The total for the whole company is simply adding the other two together. Not terribly challenging, right? Notice that Excel would be great for that. Cost of goods sold, same thing. All of these are recorded in their own general ledger account. Park them on your income statement for each of the 2 departments. Calculate cost of goods sold and gross profit. Questions? Okay. Everybody looks thrilled. Somebody at least fake it. Okay. Direct and indirect expenses. This is all of the expenses that go down below gross profit, okay? Normal expenses. Direct expenses are simple. If I'm paying my employees and I know the guy worked in the shoe department, I record his wages as a shoe department expense. Good? It's the other items, the indirect expenses, that are not tied directly to a department. So I don't get a utility bill for just the shoe department, right? I get one monster utility bill for the whole building, and I've got 7 departments in the building. How do I split that up? How do I record that? Oh, take a stab at it. Don't shake your head, no.
Well, there's a few different ways that you could do it. I mean, some departments always use more electricity than others. You might have a sign or something.
Right.
Or you just straight up split it by 7.
See, he's named several ways. There are always multiple ways to do it. The easiest one is take the total utility bill, divide by 7. There's 7 departments, right? 1/7 goes to shoes, 1/7 goes to clothing, 1/7 goes to jewelry. Okay? Now, that may work out fine if, in the real world, everybody uses about the same amount of electricity. Okay? In a department store, maybe. In a factory, different game. Right? If you're running some big equipment over here, and over there we just have things stored, where we just have pallets of finished product, much more utility usage, power usage in the equipment. So you're going to have to allocate it a different way. Yeah?
So this is where you use like a predetermined overhead rate?
Or I'm telling you, you may have to calculate or figure out the overhead rate. So one of the common ways to split up a utility bill is square footage used. Okay, so this department uses way more square footage than this department, right? So the shoe department is way bigger than the jewelry department, so we allocate more of the utility bill to them. Or if I know that I've got some lights over here that consume X number of watts per hour, and I've got these great big kilns over here that suck down power like I should have my own nuclear reactor, you can figure out the kilowatt hours used and do some math and come up with a ratio. So you're going to determine that overhead rate. If you walk into an existing company, someone's probably already done it, but from time to time you update them. Right now, I'm doing budgeting for next year at work, and we've historically allocated insurance expense, general liability insurance, based on revenue generated at each warehouse. So you get X number of dollars of liability expense based on the fact that you probably had, that percentage of goods go through your warehouse. It's based on how much inventory you probably had all year. We're changing that up. We're not going to use revenue anymore because we have a new facility where we're just using it for safety storage. So it will have no revenue. But I have to allocate some element of cost to that. So we're now doing it based on average inventory during the year. Okay? So I'm changing the rule based on a new necessity or new conditions. Okay? So there's always a way. And there's usually several. You just have to figure out which one most closely represents the real world. Kind of like depreciation, right? Okay. Here's the fun one. Semi-direct expenses. They're not direct expenses by any means, but they're more related to certain departments than others. So here you're going to come up with a sort of a custom way to allocate these costs. Good? And go ahead.
An example of
I was going to say a good example of that would be if you had a steel mill, okay, and we store a bunch of finished steel, rolled steel over here in this part of the warehouse. All that we've got over there are some lights. Well, anybody seen pictures of a steel mill? They suck up an incredible amount of power because they have to heat it, melt it, roll it through these big machines, all kinds of stuff. So over here, we've got this great big area where we're melting metal. So it sucks up a ton of power. So my energy bill is more closely related to that department than some other department. Right? And if our storage happens to be outside with no lights, maybe the storage gets no allocation. So you've kind of got to look at how it's being used. Right? We're going to charge some to the accountants inside that are keeping track of things because they turn the lights on during the day, but the storage is outside and there's no lights. But we've got this great big monster over here that's sucking up all the power. So it's directly related. Okay? How to calculate it. Okay. This is a good point. Everybody remember the worksheet? After we do the adjustments, i.e. after we make sure we've recorded all expenses for a given accounting period, then we go and we do the allocations of the expenses. There's always a way to calculate it. Some common ones. You're calculating, remember how I said a minute ago I was allocating my general liability insurance based on sales? So if warehouse A has 10% of sales, they get 10% of the liability insurance. So as a percent of sales is a good one. This is the one I switched to. Percentage of inventory on hand. Average inventory held in that warehouse as a percentage of total average inventory for the whole company. Okay? Square footage. How much space do you take up? Not just between your ears. I got at least a giggle out of somebody. I love it. Proves that you're still breathing. And
What was that last one?
square footage. How many square feet you use. Rent expense is a good example of how to allocate it by square footage. Delayed laugh, I like that. So, just as an example, if you're, let's go back to our Macy's example. Clothing is 2,400 square feet, shoes are 600 square feet. That's not a typical Macy's I've been in lately. The shoe department is pretty big, right? So there's 3,000 square feet in the store. It's 80% clothing, 20% shoes. So whatever your utility bill is, or rent expense is, you can allocate it 80-20, based on that rule of thumb. Simple? Does Excel lead itself to this real well? Oh yeah. And there's some math. Good? Allocating $19,200, 80-20. Good enough? Pretty exciting. Based on the value of the assets that you employ in the business. So again, think about it. This is a good one for something like liability insurance. If you have a whole ton of equipment that is insured, and the accountants have a couple desks and some calculators and some file cabinets, who should take the bigger share of the liability insurance? The equipment with all the value, right? If it gets lost, that's what we want to get replaced. So utilities based on square footage sometimes. If you assume everyone's using the same amount of utilities evenly, you could base it on square footage. If it's someone uses it more heavily than others, you're going to come up with a different method of allocation. Office salaries are easy. We talked about that. You know where the employee worked, right? You only work in shoes, and you only work in jewelry, so all of your costs are going to get put to jewelry, and yours are going to go to the shoe department. Good? Okay. Non-departmentalized expenses. Okay. here's the point of this. Remember we have other income and expenses down at the bottom of our income statement? And there are things like interest expense and interest income. If we're a department store, are we in the business of lending people money? So interest income would not be our general form of revenue. Therefore, it goes in other. And interest expense always goes in other. They don't get allocated to the departments. And I'll show you an example of an income statement with that. But they just go at the bottom, okay? So just so you know, these elements don't get allocated. Everybody good with this? Is anybody not awake anymore? Okay. Come on. All right. Department income statements. Just show us some. Okay. There was a definition I skipped that I want to hit real quick. When you're dealing in these departmental income statements, each department has what you currently are thinking of as profit or loss. Did the department make money or did it not? And since it's not a complete income statement for the whole company, it's called the contribution margin. So, which is different from profit margin, by the way. Gross profit margin. Did the department contribute profitably to the bottom line of the company? So what we want to look for is a positive contribution margin and enough contribution margin to cover the G&A, the overhead that gets allocated to the department. I'll show you an example. Yes. Contribution, the amount each department has earned beyond its direct costs. We got this, right? What's direct costs? Remember the first slide where we calculated, where we had the two departments and we showed revenue and then cost of goods sold, gross profit, right? Then we've got direct costs that go with it. Salaries and wages, and other things that we know are only attributable to a certain department. So for example, let's go back to General Motors. If we pick one factory at General Motors, let's say they build trucks. They have revenue, they have cost of goods sold, they have wages expense. Since they only build trucks, all of the rent for the facility, all of the utilities are 100% attributable to that particular factory, correct? So those are direct expenses in that scenario. So you would deduct all those direct expenses and come up with a contribution margin at the bottom. Yes?
It wouldn't be your contribution margin is your revenue minus variable expenses. It's just not including fixed because it's different.
No, you're headed down the right path.
Okay.
So let me just go through an example, okay? After contribution margin are the non-direct expenses. Like General Motors has a bunch of overhead, right? They got a couple big buildings in Detroit with some big wigs in it. So those expenses would get allocated across all of the factories. So those expenses come after the contribution margin. And that's what I want to talk about here. That's the point of this slide. Good? Good? Good. Okay. So gross profit on sales minus direct expenses gives you contribution margin. Then you have your general and administrative beyond that. Okay? Yes. Okay, here we go. Here's our Macy's example again. Clothing, shoes, total. Gross profit on sales. We got this far on that first slide, right? Total direct expenses. This is your wages and other items that are direct expenses for the clothing department and for the shoe department over in this column. Gross profit minus direct expenses gives you contribution margin. Then you have your indirect expenses. And then you get net income. Good? Okay, everybody's with me. And then the total over here. You just total the two columns across, do the math. Okay. Here's some of the things here's some of the challenges you'll run into. As the accountant, the management team wants you to put departmental income statements together so you can, here's the key word, evaluate the performance of individuals in the company, right? The individuals who do not perform well or who do not make their bonus amounts are going to challenge your numbers. Why? Because that's the easiest thing to do, right? No, I'm not doing a bad job. It's their numbers. Their numbers are bad. Here's the kind of stuff that they will throw at you. And it's easy to knock down their arguments. Okay? It's difficult to determine a fair allocation of semi-direct and indirect expenses. Okay, let's go back to our Macy's. We have a shoe department and a clothing department. I allocated it based on square footage. Gee, Mr. Manager, how much square footage does your shoe department take up? Is it not therefore fair to allocate your rent based on square footage? Right? Isn't the lease with the landlord a cost per square foot? Right? So you can kind of throw this stuff right back at them. Difficult to assess outcome if certain departments were eliminated. This is a true statement. So one of the things we're going to do, and I'm going to go back. Notice that we have our clothing department and our shoe department, and they both generate positive contribution margin. That's good. They both generate positive net income. Okay? Now, if, let's say the shoe department had a negative net income, if I eliminated it, the company would be better off, right? Because we'd have more profit. Maybe, maybe not. Here's the thing you need to be careful of. If we're allocating these indirect expenses between the two, those indirect expenses may continue to exist no matter what. Think rent, for example. I rented the whole building. It's 3,000 square feet. If I eliminate the 600 square foot shoe department, does my rent go down? No. So all of a sudden the clothing department would have to absorb those costs. So am I truly better off by the loss that is going on over here? Maybe not. Maybe this generates enough contribution margin to eat up some of the indirect expenses, and therefore it's okay. Everybody see the concept there? All right. Sometimes I have students going, I don't get that one, but you guys are pretty sharp. So, okay, so you have to really look at that close. If you ever are in that situation where you're talking about eliminating a department, you got to look at the detail real close before you decide to pull that trigger, because the remaining departments may have to absorb more overhead. Okay? You may not end up better off. This is a true statement. When you go look at published financial statements, do they break it down like this typically? No. Do you see contribution margin? No. These are commonly used, though, inside the company by the managers to make business decisions as to whether or not to eliminate divisions, locations, certain products, product lines, things like that. Yes?
What do they do with seasonal stuff?
Seasonal stuff has the same event.
You go up and down, so your contribution margin would go up, fluctuate with the seasons. So
right.
Making some summer stuff.
But you're going to have an accounting period that's typically a year long. So during the year is your seasonal hard goods. Let's talk Orchard Supply, right? They have seasonal hard goods. They sell lawn chairs and umbrellas and stuff like that. So do your seasonal hard goods create positive operating contribution? If not, let's not do this anymore. Does it cover its allocated overhead of the square footage you dedicate to it and all the other things that it needs to absorb? If not, we need to look at it hard, and maybe we don't offer those things anymore. So just because it's seasonal doesn't mean you can't analyze it the same way. because you just look at the entire year as opposed to month by month by month. So for example, if I have seasonal hard goods, and in January, what seasonal hard goods do I have out? None. So I don't allocate any square footage to them. I don't have employees stocking it, so I have no wages for it. So some of those costs go down for that month. But for the entire year, did it make me money? Okay? Here you go. This is a little involved, but a business, what is break even? When a business generates enough revenue to cover all of its expenses and its profits are zero, it's breaking even, right? We've all heard this expression in some fashion. Break even is also when your contribution margin equals your fixed expenses. Here's what you were looking at, okay? So you calculate your way down to contribution margin, you look at your fixed expenses. If I come to zero, I'm good. If it's negative, you got a problem, okay? Dividing fixed costs by the unit contribution margin. What that means is take your contribution margin from here. Let's say I sold 1,000 Cadillacs and my contribution margin is X dollars. Divide X number of dollars by 1,000 Cadillacs. It's contribution margin per unit. So divide the fixed cost by that margin per unit, and you know how many units you have to sell to break even. Good? That's called break-even units. Everybody good with that concept? As I move the mouse again. Could somebody nod yes or no? Maybe?
Yes.
I'll accept maybe. Okay. A lot of times we'll figure out the number of units for break even, and then you'll use that and you start to budget based on units as you go forward. The sales department will come in and you'll have them say, okay, how many units are you going to sell this year? Well, I'm going to sell 2,000. And you can work your way into budgeting based on knowing what the contribution margin is generated by each of those. Yes?
So in this book, we're basically saying that fixed cost is the same as the indirect cost.
Yeah, sort of. Now, think about it though. There's a, I don't want to say yes. There's a difference. Your fixed costs are the things that you're committed to no matter what. So if I'm running a Macy's store, let's assume I only have one. Okay, I've rented the building, I'm in a lease. I can't get out of it, I owe them the money every month. That's a fixed cost. I have to pay it. However, if I sell 0 units, I could lock the doors and not have any employees. That's a variable cost. And I don't turn the lights on because I'm not open, that's a variable cost. So you've got to stop and look at it that way. Okay? Yeah. Units multiplied by the selling price per unit and you get sales, right? Good. Questions? Answers? Excited?
Yes.
Yes?
Yes.
Sick and twisted. Turn that off for just a sec.